Hey, welcome back. Today we're talking about what is a hard money loan in real estate. So you've been around the real estate game for a little while. You've probably heard of hard money loans. You've heard of them as being a fast source of capital when you've got a hot deal and you don't have the money to do it yourself. Today we're going to take a look at that, look at the pros and the cons, the risks and the rewards, and some different options to hard money loans. So what is a hard money loan? A hard money loan is money that usually a private investor gives you, a hard money lender gives you, to purchase or renovate a property. So who are these hard money lenders? These are what I call real estate loan sharks. Now they're just not as bad as Vinny, from The Sopranos or something like that, but the idea is these people get you money quickly, but they're going to charge you a lot of interest to make that happen. But again, this can be a big benefit if you need cash quickly to do a deal and you don't have other options available for you. So how does a hard money loan work? Well, typically the lender, the hard money lender, is going to loan you a certain percentage of the real value of the property. Typically this is around the 60 to 70% of the value of the property is what they'll give you as a loan. It doesn't really matter how much the property cost you, it's what the real value is. And the way that the hard money lenders make their money, a couple of different ways. They might charge you what are called points up front on the loan. So let's say you need to borrow $100,000 and they charge you 4 points. That means right off the top, they're going to charge you $4,000 to borrow that $100,000. And then on top of that, they're typically going to be charging you interest. They're going to be charging you a fairly high interest rate. So it might be 4 points plus 12% interest. So that means you're going to have to pay $4,000 for the initial cost of the loan plus 12% interest, usually calculated as simple interest. So that means on $100,000, 12% interest would be $12,000. So if they're dividing that on a monthly, that would be $1,000 a month to pay for that loan. So it's $4,000 plus $1,000 a month. Other hard money lenders might just charge you a higher interest rate. So they, instead of charging you points, they might charge you a higher interest rate like 18% on the money. So, if that's $100,000, that means it's going to be $18,000 a year, which if you divide that by 12 comes out to whatever that is, $1,200 or whatever, and that's what you're going to be paying every month. However, if you're in and out of the property fairly quickly, that actually might be a better deal for you than doing the points plus the lower interest rate. You have to really take into account how long it's going to take you to pay off that bill, to pay off that loan. So that's how, in a nutshell, a hard money loan works. So what kind of properties are usually financed with hard money loans? Well, hard money lenders usually lend on non-owner occupied properties, either single family homes or commercial properties. So usually not the house that you're living in, but it's a property that you're going to buy and you're going to fix it up and you're going to flip. Quite often flippers are the ones that are really using hard money loans. Other people who use hard money loans are folks like people that are doing BRRRRs, same kind of idea as a flip, but they're going to hold the property after they finish doing all the renos. Those are the two most common areas where people are using hard money loans. So what are the loan terms and the interest rates? Well, as mentioned before, interest rates can be all over the board. Loan terms are usually quite short. So you're usually looking at 6-month term, maybe a 12-month term on these kind of loans. And then if you need to extend that, you have to pay some more fees to make that happen. But typically, hard money lenders, kind of like Vinny, the loan shark, want their money back really, really quickly. So this is a short-term financing option. And again, as far as how much the fees are, some loans, they charge points, might be 2 points, 3 points, 4 points, plus an interest rate. Others might just charge you a few fees, plus a higher interest rate. It really depends on the individual lender and your ability to negotiate. So what are the big benefits of getting a hard money loan? Well, speed and lack of personal qualifying. Those are the two big benefits. So if you need to close on a property really, really quickly and you don't have the cash to do it yourself, a hard money lender might be the perfect choice because they're going to take a look at the property. They're going to see how much it's really worth. They're going to see what the financials are on that property, and they're going to make a decision very, very quickly, much faster than you can ever get from a traditional bank. Now, the other big advantage is the hard money lender doesn't really care that much about your personal situation, your personal financial situation. It's all about the property. How much is that property worth? So in our example there, if you're getting a loan for $100,000, if that property is actually worth $200,000, a hard money lender is probably going to be very comfortable about loaning $100,000 on it. In fact, in that case, you might even be able to get into that property with no money down because of the value of the property. But more typically, the amount of the loan is going to be up to 70% of the value of the property. So let's say that property was worth $100,000. You would probably be able to get a hard money loan for $70,000. You'd have to come up with the other $30,000 some other way. So what are the risks of doing hard money loans? Well, as a borrower, your risks are, number one, the cost of the money. So for example, if you're doing a flip or some sort of a short-term type strategy and the property takes a lot longer to finish than you thought, or it's more expensive to finish than you thought, that can get you into hot water. You have to be very careful about that. A lot of people had this challenge with the pandemic. They were in the middle of a flip and then you had the whole supply chain issues coming in. You had the challenge with getting good labor. You had all of those challenges came in. You had the challenge of increasing costs of supplies. So if you're locked into a certain loan at a certain rate and your deal takes a lot longer to finish, that's going to come out of your pocket. That's going to be very, very expensive very quickly. So that's a big risk. The other risk is, you know what? Some hard money lenders can kind of be like those loan sharks. So they got different things and different details in their agreement with you that if you miss a payment or you're late on a payment, they can basically foreclose on you. They can basically take the deal away from you. So you have to be very careful with hard money lenders and make sure that you understand what the agreement says. Typically, they don't want to do that. They just want to make a good return on their money, but you have to understand what the risks are. So you're interested in hard money lenders, where do you find them? Word of mouth is probably the best way. I mean, of course, you can check on Google, you can look for ratings, all that kind of stuff, but probably the best shortcut is find other people who are using hard money lenders and get their referrals. So if you belong to a local real estate investment club or a RIA, go to the RIA, find out who the other flippers are, and find out who they are using for their hard money lenders and get those referrals. Now, there's a different way you can go instead of using hard money lenders, and that is using private lenders and joint venture partners instead. So what's the difference between a private lender and a hard money lender? A hard money lender is a professional who is in the business of loaning their money, right? They're that real estate loan shark type person. On the other hand, a private lender is usually a private individual who's using their money to invest in real estate as an investment, not as their primary business. So if you find a private lender, chances are you can get much more reasonable rates and much lower interest rates. You don't have to be paying points on this. You got more flexibility. It can be longer term, can be much more affordable money. Another option is working with joint venture partners. In that case, the joint venture partner is bringing the money to the table. You're bringing the deal, you're bringing the team, you're bringing the expertise, and you're sharing the risks and the rewards together. The beautiful thing about working with a joint venture partner is you don't have to pay them until the deal starts making money. They're making money when you're making money. You're making money when they're making money. It's a partnership. So that's another option you can look at instead of hard money lenders. And if you like the idea of finding joint venture partners and private lenders instead of hard money, then grab a copy of my book, Money Partner Formula. That's what this is all about. Click on the link in the description below or go to investorattractionbook.com and get your free copy today. This is going to show you my step-by-step process for attracting investors, for attracting private money lenders, for attracting joint venture partners instead of chasing after them. And this is going to allow you to get the best money at the best rates for your deals.